Welcome to Assessing Risk Tolerance 101. When determining how much risk you are willing to take on when entering into a trade or when you're getting started with investing, you have to assess the opportunity to achieve positive outcomes with the risk incurred at the time of the trade. So it's important to understand, first of all, that the price of a stock is not determined in the same way that the price of a product or service is determined in the marketplace on a day-to-day basis. So when you go to the grocery store, the price of each product is not fluctuating while you're in the grocery store. So you know what the price is going to be when you go to check out. But trading is not like that. So, for example, you watch shares of a stock fluctuate from moment to moment, but the product that the company sells that sits on a shelf doesn't fluctuate all that often. The price of a good is priced to make a profit and is largely fixed, but the company's stock fluctuates from moment to moment because its current price is based on the idea of where the company is heading in the future, and the parameters that determine that are constantly changing. And these fluctuations represent traders reassessing the price over and over and over again based on things like the potential of future profits, whether or not others view the company and profit potential as being favorable, and how much global events will impact the company, and if they're on track for favorable earnings. What you want to look for is a stock that has a good return based on the risk. Just because something has a promise of a huge return, like penny stocks or something like that, doesn't mean it's a good risk. So just because your friend tells you that he knows about this really hot stock tip of some company you've never even heard of and he says it's going to be huge, it's probably not going to be. And there's a huge risk there. You know nothing about it. Just some friend you have has told you it's going to be great, it's going to explode, and this guy's probably always broke. So you have to assess the risk before you enter into any kind of trade like that. So you have to assess the risk and what you're going to get for it. And you've probably heard this referred to as a risk-reward ratio. And we all use a risk-reward ratio whenever we're making any decision, really, or we should be. So there's something that's called the Stifel Risk Assessment Model. And it's one way that typically risk is determined when it comes to investing. And people identify it by this model. And it is a good guideline for helping you to kind of figure out where you're at. So you have at the very bottom, you have a very conservative investor. It's someone who values protecting their principal, the money that they've put in, over appreciation. And this person is very comfortable accepting way lower returns for a higher degree of stability. And typically this person seeks to minimize all of their risk and loss of their principal. So this is not someone who's seeking a lot of growth. So then just above that person on the ladder, you have a moderately conservative investor who values preserving their principal, but is comfortable accepting a very small degree of risk and a tiny bit of volatility to get a little bit of appreciation on their principal. And they still want greater liquidity also, but they're willing to accept lower returns, and they're willing to accept very minimal losses. So a more moderate investor values reducing their risk and they want to increase their returns, so they're not as interested in capital preservation like the other two. And they'll accept some modest risk in order to get a modest return. And they may even be willing to endure a short-term loss of some of their principal and a lower degree of liquidity, but it's in exchange for a longer term appreciation. So above them on the ladder, you have moderate growth. And this investor values higher long-term returns, and they're willing to accept a pretty considerable risk in order to get that. So they're comfortable with short-term fluctuations in the market with the idea that they're going to realize those returns later. And then there's the moderate growth investor who is above them on the ladder. And this person values long-term returns that are higher, and they're willing to accept pretty considerable risks to get those. So they're comfortable with short-term market fluctuations in exchange for a long-term appreciation of their capital. And they're willing to endure pretty short-term losses of principal, even big chunks, with the potential for higher returns in the future. So liquidity is not very important to this kind of investor because they're seeking growth. So above this investor, you have the moderately aggressive investor, and they primarily value longer term returns, and they are willing to accept a great deal of risk to get those.
So let's discuss the risk assessment model. Let's start with the bottom with the conservative person who values protecting their principal over seeking gains. And this person is very comfortable accepting very low returns in exchange for a higher degree of liquidity at all times, stability, and a complete lack of volatility. Basically, they want to completely reduce their market exposure. This person seeks to minimize risk and the loss of principal.
Next, we have the moderately conservative person that primarily values principal preservation, but they're actually comfortable accepting a very small degree of risk and a little bit of volatility in order to get some returns. They also desire greater liquidity, but they really want a little bit of returns, and they're willing to endure some tiny losses to get those. The moderate person values reducing their risk, but also enhancing their returns pretty equally. And they're willing to accept some modest risk, not anything huge, to seek higher returns. And they're actually willing to endure some short-term losses of their principal and even a lower degree of liquidity in exchange for that kind of return. But they also don't want to be too exposed in the market. So they're looking for some protection, but also some growth. And next we have the moderate growth person who values higher returns, but they're willing to take on a considerable risk to get those. Unlike the previous groups we've talked about, they're actually comfortable with short-term fluctuations in the market as long as they're getting those returns, and they're willing to endure larger short-term losses of principal in exchange for the potential of higher long-term returns. So liquidity is a secondary importance to this type of person. Then we have someone who's moderately aggressive, and this person primarily values higher long-term returns, and they're willing to take on a significant risk to ensure those. They believe that the higher long-term returns are actually more important than protecting their principal. And this person may be willing to endure very large losses in favor of potentially higher long-term returns. So liquidity is definitely not a concern to this type of investor. They're looking to keep their money in the marketplace for quite a long time. And lastly, we have the aggressive person who values maximizing their returns and is willing to accept a pretty substantial risk. They believe that maximizing those long-term returns are actually way more important than protecting their principal. And because of this, they're willing to endure extensive volatility in the market and significant losses as well. And liquidity is definitely not a concern to this individual. These are just some basic guidelines. But ultimately, if you find yourself identifying with any other category other than aggressive or moderately aggressive, then trading may not be for you, unless you're actually willing to train yourself to engage in risk taking and get comfortable with risking significant loss in order to maximize your gains in the short term. So let's go ahead and discuss risk tolerance levels. This leads us to how we can set our risk level and make sure that we don't risk too much in any one trade. A single trade should use around only 1 to 5% of our portfolio on any given trading day. So this means if you lose that amount at any point during the day, you get out and stay out of the market. Ultimately, this decision depends on your trading style, your risk tolerance, and what you put in your trading plan. let's discuss risk tolerance levels. So a low risk trade would be about 1 to 2% of your total equity. A medium risk trade is approximately 2 to 5%, and a high risk trade would be 5% or anything greater than that. While something extremely reckless would be approximately 20% or more of the total equity in your trading account. So if you find yourself in a position where you're risking more than 20% of your total account on a single trade that some douchebag told you about on TV or the radio or a podcast, complete with honking horns, then you need to make sure to give your local Gamblers Anonymous program a call or just head to the casino.